The best performing asset class of 2025 was emerging markets. The emerging market index was almost up 35% in 2025. Between 2002 and 2008, US markets went almost nowhere, while emerging markets delivered nearly 4x returns. Whenever companies like Nvidia or Google want to manufacture advanced chips, they have to go through TSMC. Hi everyone, I'm Yogesh, partner at Magnus Hathaway Investments and your host for this channel, where we discuss everything about financial markets. Today's video is really special because we are going to talk about a trend which might dominate the markets for the next decade. The best performing asset class of 2025 was emerging markets. The emerging market index was almost up 35% in 2025. Now, let me zoom out the chart for you. What's interesting is that the emerging market index had barely moved for nearly 12 years before this rally. It recently broke above the high it made back in 2008. When you look at the returns on a CAGR basis, it is terrible. Decade-long breakouts are extremely rare, and when they happen, they're worth tracking very closely. Because this is usually when majority of alpha gets generated. In my view, these moves are driven purely by cycles. Between 2002 and 2008, US markets went almost nowhere, while emerging markets delivered nearly 4x returns. Then, over the last decade, from 2010 to 2025, US markets did most of the heavy lifting, delivering around 14 to 15% CAGR. During that period, emerging markets remained largely stagnant. Now, I believe the cycle is ready to change, and there are multiple reasons for this. First, earnings. Earnings are the fundamental driver of long-term price returns, and we'll discuss this in more detail shortly. Second, the US dollar started weakening. As interest rate cuts come into focus, investors who had parked capital in the US are now looking to redeploy money elsewhere, and emerging markets are a natural beneficiary of that shift. Let me explain this with cycles again. If you look at the MSCI emerging markets versus MSCI world, from 1988 to 1994, emerging markets did the heavy lifting. From 1994 to 1999, during the dot-com era, developed markets, especially the US, outperformed. Then again, from 2002 to 2008, emerging markets dominated. And since 2010, the cycle has been clearly led by US markets. These are long cycles. When they turn, they don't turn for a month or even a year. They turn for multiple years, and they reset return expectations entirely. Now, coming back to earnings, the foundation of any sustained rally. In 2024, emerging market earnings grew by about 10%. In 2025, earnings accelerated to nearly 17%. In comparison, US earnings grew about 13%. Looking ahead, emerging market earnings are expected to accelerate further, potentially reaching 30%, largely because many of these economies are deeply linked to commodity cycle, which has clearly turned positive. There's also a major technology angle here. China has now fully embraced AI. Taiwan plays a critical role through TSMC, which is the largest and most profitable AI chip manufacturer. Whenever companies like Nvidia or Google want to manufacture advanced chips, they have to go through TSMC. So what exactly do we mean by emerging markets? Primarily, we are talking about China, Taiwan, South Korea, India, and Brazil. Taiwan is central because of TSMC. China is largest component due to its scale. South Korea plays a key role in semiconductors and electronics. India is one of the fastest growing large economies globally, and Brazil is heavily linked to commodities. Each of these countries has its powerful growth drivers. China, for instance, is far less affected by US trade tariffs than many believe. It controls access to rarer elements, which are critical for AI, EVs, and future technologies. India benefits from strong consumption growth, favorable demographics, and its position as the fastest growing major economy in the world. Brazil stands to gain significantly from the commodity upcycle, which looks set to play out over the next decade. There's a common argument that emerging markets lack futuristic AI technologies. That's simply incorrect. China has the world's largest EV manufacturer, which is BYD. It is also building its own AI chips and AI models at scale. Taiwan, through TSMC, sits at the heart of global AI supply chain. Quite simply, nothing in AI moves forward without it. Finally, consumption. China is the consumption-driven economy. India is also a consumption-driven economy supported by a massive demographic dividend. This combination creates a powerful long-duration growth runway. So overall, this shift in emerging markets hasn't happened overnight. It has been building steadily over the past few years. Now, multiple forces are aligning at the same time, accelerating earnings, a weakening US dollar, expected US rate cuts, and improving global liquidity. In our view, this is the phase where everything is finally coming together for emerging markets. At Magnus, we spend a significant amount of time researching global economies, individual stocks, and long-term structural trends. Every piece of content we create is backed by deep work and serious analysis. If you found this valuable, it would mean a lot to us if you shared this video with someone who could benefit from it. Don't forget to like the video and subscribe to the channel so you don't miss our upcoming research and insights.